Hello everyone, this is Pragya Gupta, first year student of the MBA BA course of SCMHRD. Here I am to give my presentation on the monetary policy of USA as a part of my assignment of macroeconomics course. So the today's presentation would be dealing with the introduction to monetary policy, why it is used, who makes it, what are its drivers, what are the common tools, and what were the various policies undertaken by the USA. So, monetary policy basically refers to the actions which are taken by a country's central bank in order to manage and regulate the supply of money and credit in the economy. So, now the question comes that why is there even a need to regulate the supply of money and credit in the economy? So, basically, the objective of monetary policy is to create a stable and predictable economic environment which fosters growth, job creation, and prosperity. And the goals and targets of the monetary policy may vary from country to country depending upon its economic and political circumstances. Now, particularly in the United States, the Federal Reserve System is there, known as Fed, which is responsible for making the monetary policies. And the major monetary policy decisions are taken by the Federal Open Market Committee, which meets 8 times a year. So the Fed Reserve's monetary policy is driven by a number of economic conditions, including inflation, employment rate, economic growth, financial stability, and international factors. Thus, we can say that the monetary policy is driven by a complex set of economic conditions, and the Fed must weigh competing objectives and the trade offs in its policy decisions. So, now let's have a look at the common tools which are utilized by the Fed time and again. Some of the most prominent one being the open market operations. Herein, these operations, the government, uh, it involves the buying and selling of the government securities in the open market. So, when the Fed is purchasing the securities, it's injecting money and lowering the interest rate, which in turn stimulates the borrowing and investment. And when it sells the security, vice versa happens. The second tool is the reserve requirement, which basically corresponds to the certain amount of reserves which the banks are required to hold. So when the Fed adjusts these requirements, let's say when the Fed reduces the amount of money which the banks can lend, uh, uh, when the Fed raises the reserve requirements, the Fed can reduce the amount of money that the banks can lend out, and which can turn reduce the inflationary pressures. Another tool is the discount rate, which is basically the interest rate at which the banks can borrow directly from the Fed. So, by raising or lowering these discount rates, the Fed can influence the cost of borrowing and, as a result, the level of lending and thus the economic activity. Forward guidance is the another tool wherein the Fed can provide a forward guidance to the financial markets about its future policy intentions. So now let's have a chronological study of the US, wherein time and again, according to the economic conditions, the Fed has taken certain monetary policy decisions. The initial states in the late 1970s, US was experiencing high inflation, and the Fed, under the chairman of Paul Volcker, pursued a tight monetary policy to combat it. Herein, the interest rates were increased to very high levels. The next era, from 1987 2006, under the chairman Alan Greenspan, the Fed pursued a policy of low interest rates, which was a hands off approach to regulate the financial markets. With the help of this policy helped to spur the economic growth, but it was also criticized for contributing to the buildup of the financial imbalances. In the era of 2008 to 14, the quantitative easing was adopted, which basically involved purchasing of the large quantities of the government bonds and other assets in order to inject liquidity into the financial system. QE is credited with helping to stabilize the financial markets and prevent a deeper recession. Afterwards, from the timing of 2015 to 2019, after several years of low interest rates and the quantitative easing, the Fed, under the chairmanship of Janet Yellen, it began to raise the interest rates and unwind its balance sheet. This time, the policy was intended to gradually return the monetary policy to a more normal stance, but it also had an effect of slowing the economic growth and causing some market turbulences. Later on, from the COVID-19 response, 2020 till present date, it's seen that the Fed, under the chairmanship of Jerome Powell, has pursued an aggressive policy of low interest rates and large scale asset purchases. This policy is intended to support the economy and prevent a more severe recession. But it has also somehow raised concerns about the inflation and financial stability. Thus, by looking at all these examples, we can say that the monetary policies undertaken, whether it be quantitative easing, inflation targeting, interest rate targeting, or forward guidance, the effectiveness depends upon a range of factors, including the economic conditions, the global events, and the ability of the policymakers to adapt to changing circumstances. So while some policies like the QE as mentioned had been controversial, but the Fed has demonstrated a willingness to use a variety of tools to achieve its objectives and support the economy. Thank you so much for joining in today.